I think global markets really have been responding to global demand. There are obviously still parts of the economy that are experiencing some economic pain, but if you look at technology sectors or even some of the industrial cyclical businesses, they've all experienced a fairly significant earnings recovery. And so, it's important to remember always that the economy ultimately is different from equity markets in terms of the drivers of profitability. And that's particularly the case in certain markets like the US and in China, where there is a very high exposure to these technology or growth types of companies. Now, the issue going forward is about whether or not the value rally versus growth that we've seen this year will continue. And our view is that instead of looking at things like bond yields, we should just be looking at fundamental forward earnings performance. Last year, growth massively beat value on earnings growth. This year, it's been the opposite. Next year, we'd expect growth to actually come back. And for that reason, we would actually recommend to investors to have a balance, but to not really throw out those companies that did well last year.
Okay. David, that's an interesting strategy. I mean, you're saying don't look too much at bond yields, but it's hard not to, given that we have the 10-year yield below 1.5 at a time when so many are still worrying about inflation. I mean, we had some big heavy hitters overnight out of Morgan Stanley, JP Morgan, Paul Tudor Jones, of course, saying inflation may not be as transitory as the Fed thinks. So bearing that in mind with the big Fed meeting coming up this week, what are you watching out for?
Well, I think inflation worries have crept up many times over the last decade. And certainly policymakers, both fiscally and monetarily, are throwing everything they can to generate inflation. And so, there are obviously many market participants that think that this is going to really work this time and maybe work too well. However, when we look at the sources of inflation, things like used cars, you can't make a new used car, so prices will go up. But when we look forward, this is really more of a temporary phenomenon. Now, there may be exceptions to that, but we do think that inflation levels that we're seeing now are simply due to low base effects from last year.